Let's be real, with literally thousands of exchange-traded funds, or ETFs, out there, picking the right one can feel like you're trying to find a needle in a haystack. But what if you had a simple checklist to cut right through all that noise? Well, today, we're going to build that exact checklist and make choosing the perfect ETF for you a whole lot easier.
Here's the game plan. We'll start with why this is so challenging in the first place, then do a quick refresher on what ETFs even are. From there, we'll dive into our 7-point checklist, covering everything from the fund's basic structure to how it fits your goals. By the end, you'll be set.
All right, first up, let's talk about that feeling. That moment when you're staring at a screen, completely lost in a maze of investment options. We've all been there.
Oh yeah, you know the feeling. You log into your brokerage account, you type ETF, and bam, you are hit with a wall of tickers and jargon. It's a classic case of choice overload, and honestly, it can be totally paralyzing.
And this is why it's so overwhelming. We're not talking about choosing between a dozen options here. We are talking about thousands of different funds, all doing slightly different things. So it's no wonder so many of us feel stuck before we even get started.
So to conquer that mountain of choices, we need to go back to square one. Let's make sure our foundation is solid with a quick refresher on what an ETF actually is. At its heart, an ETF is actually pretty simple. The easiest way to think about it is like a shopping basket, but instead of groceries, it holds a whole bunch of different assets, like stocks, bonds, you name it. And the basket's main job is just to copy or track the performance of a specific index. So if the index goes up, your ETF should go up right along with it.
And to make this a little more real, take a look at these. The SPDR Straits Times Index ETF, that's one purchase that gets you a small piece of the 30 biggest companies in Singapore. Or how about the Lion Phillip S-REIT ETF? That lets you invest in a whole portfolio of Singaporean real estate all in one simple package.
Okay, with the basics locked in, it's time to start building our checklist. We're going to kick things off with the first 3 essential checks. Think of these as checking the fund's foundation.
These first 3, you just can't skip them. We need to look at how the ETF is built, who is building it, and just how big and stable it is. Getting these right from the get-go is absolutely crucial.
You know, an ETF can follow its index in 2 totally different ways. With physical replication, it's simple. The fund just buys and holds the actual assets. But with synthetic replication, it's using complex financial tools called derivatives to mimic the index. This can sometimes mean higher returns, but it also comes with more risk. You just need to know what's under the hood. Next, and this is a big one, who's actually managing the fund? You really want to go with a provider that has a long, solid track record. You know, names like BlackRock, State Street, Vanguard, these guys are giants in the industry for a reason. It just gives you peace of mind.
And just like you want to trust the provider, you want to see that other investors trust the fund too. That's where AUM, or assets under management, comes in. Think of it as a sign of popularity and stability. A fund with a huge AUM is usually more liquid, which means it's much easier for you to buy and sell shares when you want to.
All right, our foundation is set. Now we're ready to go a little deeper. The next 3 checks are all about the numbers, how well the ETF does its job, and of course, what it's going to cost you.
So now we're getting into the nitty-gritty. How well does the fund actually track its index? How easy is it to trade? And maybe most important of all, how much are the fees? Because these 3 things directly affect the money that ends up in your pocket.
Remember, an ETF has one main job: follow its index. The tracking difference tells you how far off it is, and smaller is always better. Then you have tracking error, which tells you how much it wobbles along the way. You're looking for low tracking error because that means you're getting a smooth, predictable ride.
Next up is liquidity, and a great way to measure that is the bid-ask spread. You know when you see 2 prices for a stock, a buy price and a sell price? Well, that tiny gap between them is the spread. A really popular liquid ETF will have a tight spread, and that's what you want because it means you're paying less every time you trade.
And finally, the fee everyone talks about, the expense ratio. It might seem like a tiny percentage, but just look at the difference it can make over the long run. That small fee gets quietly taken out year after year, and it can eat up a huge chunk of your potential returns. The lesson? Lower is better.
So, we've covered the technicals and the costs. Now we're at our 7th and final check. And honestly, this might be the most important one, because this is where we make it all about you. A really key choice you have to make is how you want the ETF to handle dividends. A distribution ETF pays those dividends out to you in cold hard cash. An accumulation ETF, on the other hand, takes that dividend money and automatically reinvests it for you, buying more shares and letting your investment compound.
So, which one's better? Well, there's no right answer. It 100% depends on your financial goals. Are you looking for a cash income stream right now, or is your focus on building as much wealth as possible for the future? Your answer to that question tells you exactly which ETF is right for you. And there you have it. That is our complete 7-point framework. We've gone from the fund's foundation to its performance, and finally, to how it fits in with your personal goals. So let's bring it all home.
And this right here is the key takeaway. It's so tempting to just pick the fund with the lowest fee or the biggest AUM, but the best ETF isn't some universal award winner. The best ETF is simply the one that perfectly fits your investment goals and your comfort level with risk.
By using this checklist, you can completely change the game. You're no longer paralyzed by thousands of options. Now you have a powerful filter. You're not guessing anymore. You're making a smart, confident decision that's going to help you build a strong financial future.
So you have the framework now. You have the tools you need to analyze any ETF that comes your way. The only question left is, what's your first step going to be?